Our guest today is Charles Jensen, Managing Director of the Investments at Inland Securities Corporation. With more than 20 years of experience specializing in 1031 exchanges, Charles has helped facilitate more than $6 billion in capital across 1031 exchange strategies and Delaware Statutory Trust investments.
Charles works with financial advisors, CPAs, real estate professionals, and accredited investors to navigate tax deferred real estate strategies. He is also part of Inland Securities leadership team, supporting strategic growth and mentoring financial professionals throughout Western United States and Hawaii. Please welcome our guest, Charles Jensen.
Hey, Charles.
Aloha.
Aloha. Can you hear me okay?
Yes.
Perfect.
Yeah. Welcome to the show. We're super excited to have you. This is like so timely because we have the DST luncheon coming up and we're going to get to see you in person on Tuesday.
You know, for those of you listening on the radio show right now, you don't have the visual, but I'll give it to you. Charles has a nice professional background, wearing a jacket and a collared shirt. Adrienne and I are in these sleeveless workout uniforms with our camel baseball caps with Team Lally license plate on it. It looks like we're coming to him from a trailer park in Waianae. And he's the professional, but there was a rhyme and a reason to that. We were talking about our fitness culture in Team Lally. We're not coming to you from a trailer park.
No, and we will be dressed in professional attire when we see you on Tuesday for certain.
No, I'm hitting on my best white beater.
No, I don't think so.
Not at that event. So,
I'll be wearing a Hawaiian shirt too. I'll be on a Hawaiian shirt next week.
We were asking Kyle, what's Charles's title? And I just said, the man. I gave you a new title. You're just the man.
Charles Jensen, the man.
So Inland Securities, we have some questions, or just let Charles just share.
Well, I mean, I want to just start it off with that. You know, I think our listeners have heard a thing or two about DSTs.
Yeah.
We'll go deeper into, but I also want to talk about that not all DST companies are created equal.
Yeah.
And in our last luncheon together, in fact, there was a lady who was complaining about she just lost everything in her DST. And that was another reason where we need to get the word out that, where you put your money with and your trust with matters. So Charles, let's talk about Inland's history and why it's such a strong company.
What's important to know?
And full disclosure, it was not an Inland deal, right? So
no, some other random company. No, you guys are golden.
No. Yeah. So who Inland is? Interesting story. We were started by 4 Chicago school teachers back in the 1960s. And these 4 teachers, when they met in teaching school, they realized they're not going to strike it rich teaching school. I mean, who does, right?
Yeah.
I found out at one point they were making about $6,000 a year teaching school. And their idea was they had summers off, they had weekends. And, this is the 60s, right? No cell phones, no email, no technology like that. So their idea was to work at the same school and use the faculty lounge phone to, call, real estate agents and do their deals, what they're trying to work on. And so they end up in the same school. They found their first deal was a raw piece of land, $4,000. They each put $1,000 up themselves. And they got a construction loan and built a 4-unit apartment building that they ended up selling for double their initial investment later. They did very well on it. The other teachers are like, hey, can we go in your next deal? Kind of like a Hui, right? And this is began the big deal of Inland. And this got bigger and bigger, but it was a teacher Hui. And they had so many deals after 5 years of teachers across the Midwest and multi-millions in investment that they went full-time into real estate in 1967. And then they just got bigger and bigger. They ran their own management company, their own trash company, their own bank, their own mortgage company. And by 1989, became the biggest owner of Walmart nationwide of the land and the buildings we leased back to the Walton Family Trust. Today, we're in the top 10 privately held landowners and commercial property in the U.S. and biggest sponsor of the traditional DSTs in the nation as well.
Yeah. So you mentioned thank you for localizing that and mentioning the word Hui. Hui, a lot of people think, and it is true that it means group, club, or association. But what it actually, the use of the word Hui is like this. Hey, I have an awesome investment. Hui, you like try join? Anyway.
I love it that it was started by the teachers. And then, Charles, is it true that there's some of them are actually still around?
Yeah. So 2 of them are still alive in their 80s at the company. And they have a whole bunch of people that have been there for 20, 30, 40 years working behind them.
Yeah.
So One became the CEO, one became head of acquisitions, one became head of marketing and chief legal counsel. So two are still alive. Two of them passed away in the last couple years or so.
Okay.
And it was sad to see them go, but we all get older, right, at some point.
Yeah, and you have processes in place where it will keep going on in perpetuity. Talk to the people about the layers and the scrutiny that you go through to offer one of these DSTs, because I think, if people are like, it's funny because people will come to these luncheons and have all these questions. And I
Yeah.
guarantee you they were not asking those questions when they looked at the investment property that they have.
Yeah.
So and went through that layer of scrutiny. They're like, oh wow, get this house in Kali. I think that thing on cash flow. That was the level of their research. Talk about, and then they're asking you guys all kind of questions, but talk about the level of due diligence that you guys do before you offer up one of these securities.
Said, if you go to buy your own property, yeah, you're going to have your 30-day inspection, however long the inspection is to go through, right?
Mhm.
And which is fine. And you can get your experts to go and look at the property. The DST is a little bit different. It's a securitized, Delaware Statutory Trust. So the first thing we do is we have our own acquisitions team that will fly out and want to approve to buy the property. We put it through a rigorous process. We have a whole committee that makes these decisions, on all facets of inland. And then what happens too is once we acquire it, if there's a mortgage on it, sometimes some of these DSCs have loans, some don't have loans. If there's a loan, of course, we went to a third party bank that's going to have to approve financing. So they're going to scrutinize the deal as well. And since it's a security, it gets filed with the Securities Exchange Commission, the SEC. They don't really approve or deny anything. You're just going on record with them. But it goes out to the financial world, all the financial brokers, right? Most financial advisors have a broker dealer. It's their parent company. And they can't just, blanket sign every inland deal that comes through. They have to do individual due diligence on every single deal as it hits their desk, right? So they'll read a 300-page document, a private placement memorandum, and the brochures and go through everything. But they have to do what's called trust but verify, right? Where they have to get a third party report. There's three major companies that do this. You get a third party report where they'll go out and fly out and kick the tires to say that, hey, our numbers jive or this property exists, whatever they're doing on the diligence. It's like a maybe 40, 50-page report that goes out. So my point is it goes through so many filters, and then the financial advisor and then the investor themselves eventually, that at some point you would hope if there was error in the deal somewhere that would get caught in those filters.
Yeah. I will tell you, I'll share a personal experience that Adrienne and I have. We've invested into a strip mall through a third party. I'm not going to mention who they are. They're a local investor. And we trusted them. Our big, it was about $500,000. So not the change in our ashtray of our car. It was big money for Adrienne and I. And so 500,000 strip mall in where? I don't know, Wisconsin.
Yep.
Anyway, and the big benefit we got was some accelerated depreciation and help us offset some taxes. But what we found out when it started not performing was that the person who went in and bought the property, professional investor, hadn't bothered to find local commercial agent representation. So what we discovered after we closed is that two very substantial leases were fake.
Mm-hmm.
Were fake, and so
There was fraud.
There was fraud involved, and then they went in to sue this person and settled on it before even talking to any of us investors. Fast forward to today, I think we got the accelerated depreciation, maybe one investment return, and the guy has filed bankruptcy. I will tell you right now, if I could go in a time machine, I would have reversed that. Wee. That's my sound effect. Hey, Charles, we got $500,000. We're gonna let's do a DST. And
that the DST is meant for the 1031
Yeah.
exchange. I know that Inland has other products, right? They have other products that you don't need the 1031 to get into, right? But
the bottom line is we would have bought some local real estate, then did a 1031, because this has all happened in the last 5 years, and we would have a DST right now. Hindsight is 2020, right? We're all brilliant in reverse.
Mhm.
But I will tell you, I'll leave you guys with this quote. A wise person learns from their own mistakes. So Adrienne, a little bit wiser by a $500,000 loss. A happy person learns from the mistakes of others. So everybody listening to this is going to be a happy person learning from Adrienne and Attilio's mistake. Come to one of the lunches, have a conversation with Charles, ask him all the challenging questions that you didn't ask when you bought your investment property, do a 1031 and go into a DST. Not any company, but with Inland. Another question for Charles.
Well, let's go over. We do have a list of questions.
Yes.
Because, our listener base is, it's vast. And there's maybe someone doesn't even know what a 1031 exchange is. They're like, what is this 1031?
I would say our listener.
Let's start there. Like, what is the 1031 exchange and how does it work?
By the way, I was on a Google Meet with somebody this morning, pretty sophisticated in the commercial world. Been doing it for 20 plus years, wrote a book. And I said, by the way, do you know what a DST is? They didn't know. So go ahead, Charles.
Should I do a shameless plug for the luncheon next week? Like the date and time? I think we all know the Mortons at the Alamona Shopping Center.
Steakhouse, Alamona Shopping Center. Second floor facing the ocean. Get one private elevator.
Yeah, exactly.
Yeah.
11:30 this coming Tuesday. So next Tuesday, we're gonna have a luncheon there. So you're welcome to attend. So what is a 1031 exchange? So 1031 is a section of the tax code that allows you to take any property that's held for investment or business use. If you follow certain rules, you can exchange into any property held for investment or business use. And if you follow these rules of buying, selling investment property to investment property, you can defer all of your taxes. They've been around since 1921, over 100 years. This is kind of how the rich get richer in real estate and create generational wealth is by using 1031. So the four taxes that you defer, you don't eliminate taxes, but defers the taxes throughout your life. And actually, upon death, there's a step up in basis to fair market value. When you die, your heirs inherit like they bought it that day, right? It's a step up in basis at that point. And so you're going to defer your federal tax, usually around 20%, your state taxes in Hawaii, right? You're going to defer your recapture of depreciation. So any tax breaks you got, the IRS could claw back up to 25%, what's called depreciation recapture of any tax write-off you've gotten. But also the Medicare tax. To afford Medicare, one of the ways it pays for it is the sale of any investment property in America. They'll charge you 3.8%. So again, with the 1031, you can defer all of your taxes. So if you had a $100,000 property many years ago, Waikiki, lots of years ago, right? It's worth millions today. It's at $2 million today. That property, if you exchanged it, you defer all those taxes. Maybe that turns into $3 million on your next exchange. You can sell that, defer those taxes. Maybe by the time you die, it's $5 million, and your heirs get a step up in basis to fair market.
So first things first is the 1031 exchange, right? You got to understand that. And then, we have this option of the DST.
So Charles, what is a Delaware Statutory Trust or DST, and what are the benefits of the DST?
Yes, great question.
Yeah. So a Delaware Statutory Trust is a form of 1031 exchange. It's actually an investment vehicle that's approved by the IRS through a 2004-86 of the Internal Revenue Code. So when you think about a vehicle, think about like an IRA, can hold stocks, bonds, mutual funds, and a gross tax deferred. 403B, 401k, same thing. So the DST is just the vehicle that can have one or more investor going to one or more property that's approved under IRS guidelines for 1031 exchange. So a DST could be, for example, maybe 3 apartment buildings in a certain state, right? Anywhere in the country. It could be a portfolio, or it could be a singular property. It could be senior housing facilities in another state, or different asset classes that are hard for people to obtain on their own. But as a hui in a group, we can obtain these together.
Yeah, I want to put my, if I went to you guys' office and you guys had a suggestion box and it said, what kind of DSTs should we look at? Here are my 2 suggestions. Any professional sports team. And then my second one is Buc-ee's.
Now, Attilio and I, we both are owners in DSTs. Our DSTs they both happen to be in storage.
Yeah.
And I think with mine that I got, I think it was like over COVID or
Wouldn't it be
something.
cool if we're like,
Yeah.
I own part of the LA Lakers?
That would be
That would
cool.
be cool.
Yeah. But I got my first introduction through Kyle, who's one of the wealth advisors that you work closely with
Yeah.
here. And I've been so happy with the returns, and just, the money just comes in every month, no worries. I also get the same benefits as I would if it was just like a regular investment property and you guys take care of the management of it. Yep.
DSTs are like Tylenol for a real estate investment. It just gets rid of all the headaches.
Mm-hmm.
It really does, yeah. There's
Yeah.
really 6 major benefits of the DST, right? Is, like you said, getting out of the management or the tenants, the toilets, the trash, the
Torching
termites, teenagers, all those
Yeah.
All those
Or
teas.
Teeny boppers.
all those
Yep.
all those bad teas. Because at some point, you wanna get away from the management and enjoy your life a little bit. I'm turning
Yes.
50 in November, say it publicly, and I already have DSTs. There's no place to start. I got people in their 90s that have DSTs because they want out of the management. But imagine getting the tax benefits without the headache of management. But also because we can have up to 500 people in this grouping. Imagine purchase. We have the same buying power as the big institutions like the Blackstones of the world to help obtain properties. Like an Amazon fulfillment center on the mainland might cost you $120 million. Hard to buy for a lot of people to buy on their own. But as a group,
Yeah.
we can do that and get higher quality property. And there's diversification too. As I mentioned, you can go into multiple DSTs. Maybe you got 3 apartments in one state and 5 senior housing facilities in another state in the country, and maybe storage facilities in another state. And you're going to sell a property and go into multiple asset classes, multiple states, multiple properties, helping to diversify risk, right?
Yeah.
Uh,
I think it'd be cool if you're in Bozeman, Montana. They got that billionaires private neighborhood, the Yellowstone Club.
Yeah.
If I had like a DST and Amazon, I'd be like, yeah, I'm here to see my business partner, Jeff. Can you let him know I'm here?
I want a piece of
Me.
this. Not a big deal.
I want a piece of one of his distribution center, one of his business partners. Let him know I'm here.
All right. So Charles, we've talked about a lot of the benefits.
Yeah.
What are some of the limitations that investors need to understand about the DST?
Yeah, limitations are this is,
Or
we've done,
differences. Yeah.
and the differences, the limitations are this is, everything has a pro and a con, right? So on one side of the coin, you're out of the management, right? Because you can't have 500 people managing that investment, that hui, right? It's chaos.
That's chaos.
What
Yeah.
we're allowing is inland and the professionals to manage the property. But because of that, flip that coin around. Now you're out of the management, the terrible tease. So I say one of the constraining factors is the fact that you lose some control. But I find investment properties, show me someone that has one investment property, and I'll show you that they have probably 10 or something, and the reality is there's probably 1 or 2 or 3 investment properties you may have. They're giving you a really hard time. Imagine getting out of that and putting the DSC. Yeah, you give it some control, but you didn't want to control that asset anyways. It was driving you nuts. And we all got to wind down at some point. I got a neurosurgeon that his 47 properties, he now has 13 DSTs, but he did it over time. He did
Mhm.
these over time, went some DSTs, and he's just downsizing as he gets older, to keep up his lifestyle. So another downside is time. So we have limited liquidity in a Delaware Statutory Trust because, some of these deals could be 5 to 7 years. It could be longer in a bad elongated economy, right? A higher interest rate economy, um, inflation, stuff like that happening can push a deal longer, or it could be faster. So you just got to wait it out on average around 5 to 7 years, give or take, for that exit. So if you need liquidity next year, yeah, this money's tied up in a DST in that time frame.
Yeah. I think what you do is you guys, when it's time to cash out, you send that song to us from, what's his name? The guy? You gotta know when to fold, know when to hold them, and
But,
you
like,
know when to
but, like-
walk away.
But why not have part of your portfolio some DSTs and some investment properties that you can create that liquidity and then, eliminate some of the stress. You can just have a little bit of everything and have that diversification,
Yeah.
right? If you want to still have these investment
I would,
properties.
if I'm an investor, take your most problem child property. A lot of turnovers. It's old. Everything is
You
breaking.
ran out of depreciation.
The cops is calling you every weekend complaining about your tenants. Do that one.
Do that one. Yeah. And that's the thing is get out of that management. And literally at DST, you collect a direct deposit every month. You're not chasing a tenant for the rent check. There's no rent check going on. You're getting direct deposits every month. I used to give
Stabilize your income. Yeah.
some of my rental properties, I used to give like a $20 a month discount if they paid me up an advance or put it on auto payment, because I don't see people. And that's the problem.
Yeah. And then you got turnover, vacancies. Adrienne, on those storage units that you own, when's the last time you had to make a decision on a blown up toilet?
Never.
How about, did you have to go and help with the auction for all the storage units?
Nope.
That people stop paying?
No, but you know what
You watch
happened?
it on TV. That's
No.
about it.
You know what happened?
What?
One time, I mean, this hasn't been recent, but this was like a few years ago. They were like, oh, we did a lot better this year than we had anticipated.
Yeah.
So here's some extra money. And they gave me an extra $7,000
That's like
that I wasn't expecting. I was like, oh, that was
That's
nice.
like driving to the parking lot of the gym. You didn't even go in the gym and you got jacked.
Yeah.
It's like just go to the parking lot. Oh, wow. I just worked out today. Ate a Snickers, turned around and went home.
When you're in a DST, if we raise the rents, it could up the income. They could put more into reserves. They could give out a 13th distribution. It depends on what the choice is. Because that's the thing is, if you're in a DST, you are the landlord. You own the property. You're being paid the rent.
Nice. Question, talk about it's a huge benefit people don't realize, but let's say I have $1 million in Hawaii. That's like average because that's our median sale price for single family. I have a single family home in Mililani, actually probably 1.5, maybe 2. Let's call it 2 million, but I still have $1 million loan on it. Talk about that debt and what happens to that debt if I do a 1031 into a DST.
All right. So let's just say it's 2 million for easy numbers. How's that?
Yeah.
We'll keep it simple. Let's say it's 2 million and there's $1 million loan. So the rule is this is 1031s in general right now. If you sold a $2 million property in Mililani, you need to go back into 2 million in real estate, equal or greater. So if you sold a $2 million property, you only exchanged 1.8 million of it. The $200,000 you did on exchange would be taxable. They call that boot in the accounting world.
Yep.
So it go equal or greater. Now, greater means you can take more money out of your bank account at a Bank of Hawaii and put it into more real estate, more equity, or take on a larger loan on the buy side, and that all grows tax deferred as you go.
And I think too is that if the debt for debt, right, gets transferred, that the other big difference with that debt is that it's not
it's a non-recourse.
Non-recourse.
So like
show up in your credit report.
for me, that was huge because when I did my DST, I thought no one could help me. I was going through a divorce. My credit was
from Kalihi had one better credit
my
score
credit
than
was
Adrienne at
shot
that
because my ex-husband was not paying the mortgage and we were both on the mortgage. And I just thought, 1031 exchange is not going to be available to me.
Yeah.
So I love it how it's like it's this non-recourse loan. You don't have to qualify for it, and you can get into that DST that has the debt, right?
Yeah, because the average person would have to go back to Bank of Hawaii and say, because if you had a $2 million property with a $1 million debt, you sold that property, that $1 million goes back to the bank, in general, because you paid off your loan. But you have to go back into $2 million in real estate. So in a DST, it's too expensive, time consuming. Everyone realized it was too difficult to go to 500 people, ask for a loan and get financing under their name. So what they did was the IRS allows the sponsor of DST. We could put that on a property. You can absorb right down on paper. So it's not harmful to you where they can come back at you. Of course, it's more on the property level, but we don't need a credit score. We don't need a credit check. We don't need approvals to get someone approved for financing because you're just on paper. You get all the write-off of the debt without the liability of the debt passed to you.
And I love this because I know that as you get past 10 properties with loans, it gets very difficult to get traditional financing.
Yes.
Right. So you can be in this DST and it's not going to show up on your credit report. So like this is a wonderful tool
or affect your ability to borrow.
Accredited investors.
Yes.
It could be a great strategy. I would just say like, hey, like if you want to learn more about the DST, some different strategies, come to the luncheon Tuesday at Morton's. we have a sign up sheet, teamlally.com/DST. Again, that's teamlally.com/DST. Charles, we've got a couple more minutes. So before we wrap it up, any last words for our listeners?
Yes.
No, I would just say, it's good if you're sitting on investment properties, you're not sure what to do and how to do it is, coming to this lunch next Tuesday at Morton's, 30 a.m. I think is a great opportunity to learn the ins and outs, all the facets of an exchange and how it works, the Delaware Statutory Trust. You got to know what your options are because a lot of people don't know what a DST is because it's just one page and 10,000 pages of tax law, you know. So, that's my main advice is know what your options are, but find ways like this to build wealth and get out of the day-to-day hassle of managing a property.
Let's say to our listeners, the only difference between you and a wealthy person is the knowledge that you have and act upon.
Yeah.
That's it.
Come get educated.
Worst case scenario, you had a great lunch and great conversation with Adrienne and myself. Worst case scenario, I don't know. I mean, even if you just got those two things, that's a pretty good day. And then Charles does like right at the end, he does like a little open mic, and so he tells a couple jokes. They're hilarious, financial jokes and stuff like that. No, it's no joke.
But
you know what's the funny
it's
part? Those investment properties that you're holding on to that are making your life challenging.
and I would say too, even if you've come to one of these before, come
again.
Every time I come to this luncheon, I always learn something new because there's so much valuable information, and also like things change too, right? So
Tax laws and things like that and updates, and then you guys talk about new properties that you're eyeballing.
What's
And
What's nice is there's no pressure at the luncheon. It's all
No.
educational, and sometimes you'll hear a question from some in the audience that will answer a question you might have or you didn't think about having. So it can
think
be
about asking.
good.
Yeah.
Yeah.
Yeah. So anyway, we have our DSC luncheon coming up. We're going to see Charles. He always I like the fact that he always opens up the event with a like really good dad joke. And it's hilarious. It's so bad it's hilarious
yes.
with his dad joke that he opens
Well,
up with.
Charles, we'll see you on Tuesday.
Yeah.
Thanks for being our guest, and look forward to our lunch together at Morton's.
Yeah.
Aloha.
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 Thank you,
Thank you all.
Charles.
Thank you.